exam on that 25th of May. Okay. So just stop sharing this one. So your submission will be 19, so we discuss on 20. Yeah. Okay, just stop sharing your attendance. So we proceed with your discussions on tutorial. At least we can discuss question 1 or questions and questions 2. What to discuss. Okay, I just want to share with you I'm going to discuss with you the journal entries only. You prepare for the statements. Yes, for the statements, you need to prepare. You just share the answer and then prepare for that one. Yeah. Okay. So we're going to look at your tutorials here. So I already write something here on this tutorial. Stop sharing this one. This one. This is my tutorials. Okay, this is already haven't have enough time to delete this one. Okay, we just discuss on these tutorials. Okay, tutorials that we have here is on tutorial 1. Going to look at that one. Yeah. Okay. So A acquired. This one is discussion with the previous class. I don't have time. Not enough time to delete this one as long as have this one. Yeah. Okay, so we're going to look at the questions that we have here. So for questions 1 that we have here is about A acquired. Okay, A acquired 90% interest in B on 1st of January. Within that one, the return profit was 1 million. Yeah? So A acquired here 90%. And then at the same date, at the same date, B acquired C for 80% or so. So 80%, this one 90, this one is 80% at the cost of 2.6 million. At the acquisition date, RE in C was 0.6. So this is the REC. And then this is the RE for B here is RE for B here is 1 million. Yeah. Okay, and then on 1st of April, A acquired 10% interest in C. So acquire again another 10% interest in C. So 10% was on 1st of April. So, but before it's acquired C 10% here, A is already have a indirect interest. A to C, they have indirect interest between through B. Okay, this one is through B. 90% time with 80%, so they have 72%. So this one indirect interest, indirect interest 72%, and then plus another 10%, the one that acquired on 1st of January 2020. So another 10%. So altogether they have 82%. Yeah? Altogether they have 82%. The 82% here is the effective interest, effective interest in C. Okay. Here 72% through B, and then another 10% acquire additional shares. Okay, so this is what you have for the income statement. Financial positions. So financial positions that we have here for the income statement. So the income statements that we have here, we focus on the items. Item that we need to focus here is your profit after tax and also the RE brought forward. Yeah? So this is RE brought forward. So these two items we need to focus here. Okay, and then the statements of financial positions here. Okay, you're going to have here the shares here, the shares in B. So investment A in B is 4.5. And then in C for that 10% here is 980. B in C here is 80%, 2.6, the amount of investment. Okay, the shares capital. So we focus on the shares capital in B, 3 million. And then in C is 2.5 million. Yeah? So 3 million, if you look at here at the acquisitions date, okay, acquisitions date, you have 3 million plus the RE here is 1 million. This one is for B. So for B, the net identifiable assets here is 4 million. Yeah? Okay, and then for C, if you look at here for C, okay, NIA for C, this one is for B, and then for C here you have 2.5, okay, plus 600. So we're going to have 3,100. So 3,100 is net identifiable asset in C. Yeah? So we need to have this information selected. Right? Okay, so we're going to have here, going to look at the additional information. So. Okay, for additional information here, okay, already calculate this one. Can I just, okay, maybe I need to delete this one first. Okay. Okay, delete for a while, so we need to discuss this one again. Yeah. Okay, wait for this one. Okay. A bit rushing with the previous class. Okay, so we can discuss this one once again. Yeah. Correct. Okay, so we said that the NCI interest, just delete this one for a while. Just close your chat box for a while. Yeah. Okay. If you have anything, you please voice out. I cannot see this one. Okay. So the NCI and B and C here are respective acquisition date was measured at fair value 5.8 and then 700 respectively. So remember that previously the net asset, okay, NIA, okay, sorry, okay, NIA net asset. In B here we have 4 million, and then in C we have 3,100. So we're going to use this information later. Okay, this is the transactions that we have here, B to A. This is the value, the NCI value. But you look at the item number 7 here. It said that the fair value recorded, the group used a fair value method to record it for the NCI in B. So NCI in B, we are using B for the NCI here. NCI, we're going to use a fair value method. So the amount going to be 580. But it said that for C, going to record based on the proportionate net asset. So proportionate net asset, the amount of net asset that you have here in C here. Okay, so you're going to have the NCI here is 20% time with 100. So you're going to have here 620. So this is the value of the NCI to answer for item number 7. Yeah. Okay, from this information, item number 1 and number 7 is selected here. So from these two information, then we can calculate for a goodwill. So we find go for B first. Okay, for B. Okay, for B, going to have COI here is COI by parents here is 4.5. Okay, and then plus the NCI. NCI using a fair value here for 580. So altogether, going to have here is equal to 5080. 5080 minus net identifiable asset, which is 4 million. So you're going to have 1080 here is for a goodwill. So this goodwill need to allocate to parent and also to the NCI. Yeah? Okay, for parents here, so parents have 4.5. Okay, 4.5 minus 90% time with 4,000 time with 90%. Yeah? Time with 90% to find parents here, you're going to have 3,600. So 3,600. So you're going to have a goodwill for parents here will be 900. So once the goodwill for parents will be 900 for the NCI here, 1080 minus 900 here, we're going to have 180. So this is what you have for the goodwill in B. Yeah? Total goodwill in B here is 1080. 900 to parents, 180 to the NCI. Yeah? Okay, now we look at C. Okay, in C, we're going to calculate for the goodwill in C. So goodwill in C, the NCI is based on the proportionate net shares of net identifiable asset. Okay, so the investments that we have here from investment by B here is 2.6. Sorry, it's 2.6. 2.6. And then plus with the NCI here is 620. So altogether going to have 3220. So 3220 minus net identifiable assets here is 3100. So we're going to have 120. This 120 is solely to parents. So parent in this case here is a B, solely to B. Because in the NCI here using net identifiable as a percentage of net identifiable asset. Yeah? Okay, so goodwill, the total 120 here is solely to parents. Yeah. Okay, so we have done with item number 1 and number 7. Yeah. Okay, so we need to look at the next one. So item number 2. So item number 2 here, B sold to A. Okay, when B sells to A, means that this one is a upstream sales. So upstream sales are going to affect the NCI. So we're going to have here source good 20% of the selling price or markup. So 20% of the selling price, total of 400. So this one is your sales 400. From that 400, 150 remain as the ending inventory. So you need to calculate for the URP here. So the URP here will be 20% time with 150. So you're going to have 50. Yeah? So this URP here is in the year 2020. So the URP here is a URP carry forward. Because this one is in a current year. So we only have one transaction here between B and A. Okay, the next one in the January 2019, okay, BA transfer equipment at the net book value of 300 to C. Transfer price was 450. So means that you have a profit here, the URP here that we have here. And this one is A to C. Yeah? So A to C, this one is considered as a downstream sales. Yeah? Okay, so the URP that you have here is 450 minus 300. So we're going to have 150. So 150 here, we need to calculate for the realizations of the URP. So realizations of the URP divide with 3 years. Yeah? So you're going to have 150. So this is also the amount of the depreciations over provided. So providers. Okay. Tax fact we need just ignore, and then resume revenue is assumed to be accrued eventually throughout the year. No changes in the shares capital for the company. So we already analyzed the items here. So we only have one transaction between B and A, and also one transaction between A and C. Yeah? Okay, so now we need to do here, we prepare the question also to prepare the consolidated journal entries. Okay, using one stage method. So one stage method here, we're going to start with the one stage method. So we're going to start with A and B, and then after that A and C. Yeah. So just stop sharing this. So already analyzed all the information. So do you have any question related with these informations that we have here? So we're going to stop sharing this one. I'm going to share with you the answer for that one. Yeah. Okay, this is the answer. So can you see this one? The answer. Is it? You can see the answer now. Okay, so we're going to proceed with this one. So these things we already discussed here. We already discussed on the effective interest. So direct that we have here in B. Okay, A in B, you have. Okay, we need to prepare the interest table. Also, effective interest table. We have to prepare for this one. Yeah. For this one, so the directs here, A to B have 90%. So means that NCI have another 10%. Yeah? Okay. And then in C, B parents have A. Parents here is A. A have a direct of 10%. This one is acquired in the year 1st of April. So 1st of April 2020. You acquired here 10% direct. So indirectly, when you acquired B, B acquired. This one is on 1st of January 2018. Yeah? Okay. We have indirect interest of 72%. This one is through B. Yeah? B then time with 80%. So we're going to have 72. NCI here. So NCI here, direct have 10%. Where does 10% come from? B have a 80% in C, and then A have another 10%. So means that altogether 90. So remaining to direct to the NCI here is another 10%. Okay, indirectly through B. Okay, through B 10% time with 80%. 10% time with 80%. So you're going to have another 8%. So total up, you're going to have 18%. This one is 72. Then if you total up this one, you're going to have 82%. And then for the NCI, another 18%. NCI. This is a balance. So the goodwills here, we already calculate. So we don't have to calculate this one once again. So the portions already calculate this one. Okay. This one, we have to be careful with this one. C and C are net asset methods. Okay, goodwills in C. A only shares 90% from goodwill in B. Goodwill by B. Okay, from goodwill of B. Okay, B receive a goodwill from C. So from that amount here is 120. But from that 120, A only have 90% share, which is 10. It's 108. So that is what we have. Okay. So from this one, we're going to prepare the journal entries here. So the journal entry here, we start with A and B. So the direct one first, we start with the direct trust. So the one that you have here is A and B. Okay, A and B here, A have 90% in B. A shares capitals, 90% is 3. RE also 90%. Goodwill is 900. We already calculate this one and then credit the COI. Okay, and then A and B has the the upstream sales. So upstream sales, debit sales, and then credit the COGS, credit sales, credit COGS. This one is to record for the sale. And then to eliminate the unrealized profit. So unrealized profit that you have here is 30. So debit COGS and then credit the inventory. So this one is for the URP, URP carry forward. Okay, and then NCI shares. Okay, since we only have one transactions between A and B, so the next one you have NCI shares in a current profit. Okay, NCI shares in a current profit. NCI has a 10%, 10% in B, 10% here, time with a current profit that you have here. A profit for the period here is 1120. This one is profit for B. And then we need to minus the URP here. So minus the URP, 30. So you're going to have 1090. So 1090 time with 10%. So shares for the NCI here is 109. And then credit NCI, segments of financial position. Okay, now we're going to eliminate for the recognize for the NCI in the shares of the company. So going to debit ordinary shares only. So NCI have 10%, 10%. So time with 3 millions. Again, to have 300 here. Return profit brought forward that you have here is okay. 10% time with 2.1. 2.1 is the RE brought forward. RE brought forward. So 210. Goodwill we already calculate for the NCI here is 180 and then credit NCI 694. So that is between A and B. We only have one transaction. Okay, any questions that you have between A and B? Is it the same as what you have? Same as your answer? Okay, so proceed now. Proceed with the next one. Okay, so proceed with the next one between A and C. A and C here we have indirect interest. Indirect interest. So indirect interest that we have here is 72%. 72%. So first thing you need to eliminate the COI. COI here 2.5 in C. Time with 72%. RE brought forward 72% also. Time with 72. Goodwill on consolidations here. The amount of goodwill in B here is B entitled 420. But B A only have 90% shares in B, so need to time with 90% only. Okay, so 108. Okay, and then the NCI here, we need to eliminate NCI in the intermediate parents. So intermediate parents that we have here is in B. So in B here, NCI have a 10% share because parents A have a 90% share. So NCI only have 10% time with the investment by B. So investment by B for C here is 2.6 million. So you're going to have 260 and then credit COI 2.6. Okay, so that one, the first one to eliminate the COI. And then this one is to calculate for the 10% additional shares. 10% additional shares. Shares that A bought on 1st of April. Okay, so we need to find the NCI at the beginning. So NCI at the beginning we have 20%. Yeah, in C. Yeah, in C. Remember that in C, B have 80%. So means that another 2% here is NCI. Yeah? So 20% is NCI. So this one is at the beginning, yeah, before the purchase of the new shares by A. Yeah? So going to have here NCI value here is 20% times 2.5. Here is the share capital. 600 is RE at the acquisitions. 1st of January 2018 here is the acquisition date. Acquisition date. So you're going to have 620 and then plus the increase in the post acquisitions profit. Shares of post acquisition profit which come from your RE and also from your currency profit. Currency profit. So RE that we have here, RE 800 is RE brought forward. Okay, and then minus RE at the acquisition. So we're going to have 200 here plus 1000 here. 1000, 1 million. So 1 million from the profit A in C time with 3 over 12. 3 over 12 here is because from the dates here is from 1st of January until 1st of April. So entitled for the 3 months only, the profit for 3 months. So we're going to have 90 here. So 90 is 2. Okay, 20% time with 200. Okay, this one is 3 over 12 times with 1000 here. So time with 20%. So we're going to have 90 here. So the total carry amount here, total up these two figures. So you're going to have 710. So transfer to parents here. So transfer to parents here, you transfer 10%. NCI transfer 10%. So 10% divided by 20% is the existing that you have. The NCI have time with the carrying amount. Carrying amount here is 710. So you're going to have 355. Okay, but the parents paid to acquire 10% here, parent paid 980. So when parent paid more, okay, paid more than the carrying amount, so you're going to have a negative movement. Okay, why this one is a negative movement? Why this one is only a movement here? Because indirectly parents has a control over the company because they share 72% and then they add another 10%. So they already have a control. So once they bought a new shares here, it's considered as a changes in the movement in the equity only. You don't need to calculate for the gain because you already have the indirectly have a control over C. Yeah? Okay, so we're going to have that one. So negative movement. Why negative movement here? Because parent paid more than the carrying amount. So to record for the negative movements here, so negative movement, you need to debit your RE. Yeah? So debit the RE, negative movement. And then this NCI here for the amount that they need to transfer to the parents 355 and then credit COI 980. Yeah? Okay. Any question for this one? So it's related with the movements of the equity. Any questions I have? We proceed now. Okay, the journal entry that we have for that one. Okay, and then we're going to get the items number 3. So item number 3 here is related with the sales of assets. Sales of asset from A to C. A transfer equipment to C. A to C. So the profit that we have here is 150. So we're going to credit machine for 150. And then this one is the transfer was on 1st of January 2019. So you're going to debit your RE. Okay, returns profit of 100. And then the accumulated depreciation here is 50 because every year we need to depreciate 50. Yeah? So accumulated depreciation here is 50 because it's only 1 year, 2019, 1 year. So this one accumulated depreciation 50, return profit will be 100. So, okay, and then so correct for the depreciations over provided, going to debit accumulated depreciation, credit depreciation at spend 50, this amount. Okay. And then I'm going to record for the NCI for the current year. NCI here, NCI shares of profit, shares of profit. Okay, current year profits 1 million times with 28%. Where this 28% come from? Previously, before itself, before 1st of April, NCI has 20%, 20%, and then plus 80% from indirect interest. So altogether, NCI have 28%. So after 1st of April, okay, the total 28%, you're going to minus 10%. So you're going to have only 18%. So this is so two portion here. One is times 3/12. The other one is 18% times with 9/12. Okay. So that is a shares of NCI portions. Okay, and then to recognize for the NCI, so you're going to debit ordinary shares of NCI 28%, at the acquisition date at 28%. Return profit 28%. This return profit is return profit brought forward. Okay, and then credit the NCI 94. Okay. Any questions for journal entry for ANC? Any questions that we have here for ANC? Okay, so we proceed now. If you have any question, please. So we proceed with the statements here. So for the statements from the journal entry, then you can prepare for the statement. Make sure that you check. Just check. I'm not going to discuss about this one. Just check for that one. So this A, B, and C. Just combine, and then minus 400 here is for the sales of the from A B to A. So from the sales of B to A, the URP same as this one. This one is the URP. Okay, cost of goods sold URP, and then less the operating expense minus 50 here is for the depreciations. Depreciations over provided. Okay, so the NCI here from the profit 33030 minus for the NCI here 314. So for the parents here will be 3016. Okay, and then this one is for the RE. So RE that we have here is RE 2709. Where to get that 2709? 2.3 here is for that three company. This one is for three company. Okay. Minus 100 here is for the URP for the equipment. Minus 900 here is for the eliminations of the COI. Okay, COI here, 900 for parents here in B. 210 here is the one that you have in B, both in B. 432. Okay, 432 that you have here is from A and C, relate with the C. Okay, 625 here is a negative movement. Okay, 224 here is from the establish the NCI, the last one. NCI. Okay, so this is what we have for the RP. Okay. Okay, and then this is the answer for the statements. You just check for the statements here. Okay, statements, either you prepare this one. The next answer, which is C and D here, we don't prepare for the changes in equity. So this one you prepare based on the changes on the equity information here. If you look at here, the ending balance for your owner's equity here, this figure. So you just use this figure. Okay, just use the figure. Okay, the difference between this answer and the next answers here, this answer for D here, assuming that you already prepared for the statements of changes in equity. From the statement of changes in equity, then you have a statements of a financial position. Okay, answer C and D here, if you don't prepare the statement of changes in equity, you need to calculate items by item for your RE. The answer will be the same. Okay, means that this one is without your statements of changes in equity. Okay, so any questions that you have for this one? Any question for question one? Question one is a simple set. Compare with the questions two. Questions three is more complicated. So check your answers, yeah? Please check. Is it okay with that one? Any of you have questions regarding this one? Is it the same? Your answers here? Why? Is it the same? Okay. So same answer. So we next one we discuss questions two. Okay. So question one is a simple. Now we look at questions two. We analyze item by item for questions two. Okay. Now we're going to look at questions two. Okay, questions two is more complicated. We get compared to question one. Yeah, going to look at this one. Okay, P acquired 75% interest in S for the cash considerations. Here is 70 millions. Okay, on 1st of January 2017. Yeah? Okay, we're going to have P and S. Okay, on 1st of January 2017. On that date, return profit was 11.4. 11.4. Okay, so you have 75% here. Okay, P subsequently on 1st of January 2018, okay, acquired 30% interest in A, 30% interest, but this one in the year 2018, yeah, 2018, this one is 2017. Okay, another 30% in A, yeah. Okay, for cash considerations of 31 million, the return profit was 8 million. Okay, P treated the investment as investment in associate and using the cost method. On 1st of July 2019, P disposed 20% of its holding in S for cash considerations of 15,300. You dispose 20% in S. So you dispose 20%, so we're going to minus 20%, so minus 20%. So you're going to have another 55%. So. Okay. So minus 20%. Okay. So this is what you have for the statements of financial positions and income statement for both of company. So you have profit after tax. So it's a thing that you need to focus here, profit after tax. Sorry. And then you're going to look at the RE. RE brought forward. Okay. That's what you have. Okay. And then you're going to look at the items that we have here. Investment in security. Okay. Investment in P here. So means that to acquire 70% P, 75% P need to pay 87,000. Okay. And then to acquire A here. Okay. So and then you have 32 investment in security 32 S. Okay, you have 32 S. We have what S here? S has 32,000. 32,000 here is related with the additional information. Okay, this one is additional information number one. So S acquired 25% in A for cash considerations of 32. Okay, that's what we have. Okay. Oh, see, this one you have 75 here. You pay only 70, 70. So means that you have another 17 here is for another investment for that 30%. Okay. So you have returns, profit, and then current liability. So this is information that we have. So now we're going to look at the additional information. Okay, additional information here. S acquired 25% interest in A on 1st of March 2020. Acquired on 1st of March 2020. Yeah? Okay, before this, we have P in S 75%. Okay, then going to have A 30%. Okay, after that, S acquired A 25%. Going to have this one. Yeah? Okay, that's it. For cash considerations of 32. So indirectly, indirect interest is 75% times 25. So you're going to have 18%. Yeah? 75 times 25. So you're going to dispose that one. Okay, so this is what you have considerations here. Okay, so we analyze item and then this transaction was not recorded by P. Yeah? By P, it's a parent set. Okay, so item number 2, look at item number 2, the one that you have here. Okay, as sold merchandise. Okay, as sold merchandise to P. As to P here is upstream, upstream. Okay, profit margin 25% on sale on in year 2020, 9. Okay, the sales here is 9 million. Out of that amount, 3.2 million still remains in the P ending inventory. Okay, so have 300s, 3.2. So 3.2 times with 25%. So to find the URP, yeah, to have that amount here, will be, we should have that one, 3.2. Okay, 3.2 times with 25 here. So you're going to have 8 million. Okay, the corresponding intercompany sales and ending inventory in the prior year was 3,800,000. So 800 times with 0.25 to find for the beginning of the year. 200 here is your RE. This one is the URP brought forward. And then we said that item number 3, we just analyze the items. Okay, for item number 3 is sold land to S. Is sold land to S here. Okay, on 31st May 2020, 31st May 2020, at the price of 5 million, the book value of the land was 4 million. So the profit was included within others income. So you're going to have your RP that we have here is equals to 1 million. The shares of the company were traded as follows. So this amount here is to find the fair value of the company. So for S, the fair value here will be 1 ringgit and 50. So 1 ringgit and 50 times with the shares capital. So shares capital for S, we are going to have the amount of shares capital here is 600. So, okay, fair value for S is 600. Sorry, 60, 660 millions with 60 million times with 1.5. Yes, you're going to have 90 million. 90 million for shares capital. Okay, this is on 1st of March. Yes? So 1st of March here is when as acquired A. Okay, the value was 1 ringgit and 40 for the S, and then for A here is 1 ringgit and 50. We're going to use this information later when we calculate the fair value of the companies. All dividend were not paid during the current year. Dividend income will include within others income, not yet paid. So you have a dividends payable. Any gain or loss on disposal are accounted in the others income. So gain or loss on disposal of shares, going to put it under others income. Company tax 24%, and the tax effects here is considered as we need to ignore that one. There is no changes in the shares capital for all of the company. Revenue and expense assumed to be accrued eventually throughout the years. Okay, and then the company policy here is to measure the NCI at fair value. So both company going to measure the NCI at fair value. Okay. Question asks you to prepare the consolidated journal entry and then consolidated statements of profit or losses. So we need to prepare that one. So I just want to show you for the journal entry. Later on, you can prepare for the statements. Yeah? From the journal entry, you can prepare for the statements. Yeah? Okay, so I'm going to start sharing your questions here. We're going to look at for the answers. Yeah? If you have any question, please. Yeah? Okay. Okay, so we're going to look at the answers that we have here. Okay, for questions 2. Okay. Associate to indirect subsidiary by step acquisitions. Yeah? Okay, so we're going to look at the answer. The first one, we're going to look at the effective interest policy. We need to prepare this one. So P, parents to subsidiary, the one that we have here. So from parent to subsidiary. To S here, parents have direct 75%, yeah, 75%. So means that indirectly NCI have 25%. So this one is on 1st of January 2017, yeah, 2017. Okay, and then parent also in A, parents have 30%, so 30% in A. So this 30% in A was acquired on 2018, yeah, 2018. Okay, so and then it said that indirectly, parents have 60% time with 25. Did you get this one? 60% time with 25. Right? Okay, before this, parent has 75%. Okay, on first of July. Okay, on 1st of July 2019, P disposed 20% of its holding. To dispose 20% of its holding. So dispose 20% of its holdings, the one that we have here is a 20%. 20% divided by 75. Yeah? We're going to have here the amount here is only 15%. Yeah? Okay. So it shows only 15%, not 20% because it disposed 20% of its interest. Yeah? So 20% divided by 0.75. Yeah? 20 divided by 0.75. So you're going to have here. Okay. So you dispose, okay, from that 75%. Okay, you dispose 20%. So dispose 20% here. So 20% time with 75%. So you dispose only 15%. So parent dispose here is only 15%. So indirectly, starting from 1st of July 2019, the parents only have shares of 60%. So 60% means that they still have a control, 60%. So now in the year 2000, 1st of March 2020, indirectly, okay, through S, okay, parents to S, okay, to S now parents only have 60%. After dispose 20%, now they only have 60%. Okay, and then S acquired A, okay, another 25%. So indirectly, parents going to have another 15%, 60% time with 20%. So now that this is what we have 16%, and then time with 25%, so we're going to have 15%, indirectly 15%. So direct interest that parent have is 30% in A plus indirect 15%, so they have another 45%. Yeah? Totals that we have here is 45%. Yeah? Okay, for NCI here, direct in S here is 25% at the beginning, yeah, 25%. Okay, indirect interest now it become 40%. Where this figures come from? 40% here. Okay, 40% here is from 25% plus another 40. Now parents in S is only 60%. So 60% means that NCI has another 40%. So indirectly, NCI has 40% here. NCI, because parents only have 60 now, NCI has a 40%. So 40% time with 25%. So we're going to have another 10%. So indirect in A, parents has 45%. Where to get that 45% here? B have an investment in A is 30%. Okay, and then S has investment in A, another 25%. So means that altogether 55%. So the NCI going to have another 45%. So this is we have 45%. Indirectly 10%. So altogether 55%. When you prepare the table, make sure that the amount should be 100%. Yeah? Total up here will be 100%. So any questions that you have for the preparations of the table for the effective interest here? Okay, any questions that you have for this one? Is it okay with the percentage here? So we proceed now, since there is huh? Mm? Mm? 20% time with 75%. Uh-huh. So uh-huh. Uh-huh. Mm. Mm-hmm. Because your slide is a difference here. Because you start from the associate to become indirect subsidiary. Okay, the one that you have in your slide here from subsidiary become associate, it will be the other way. Oh, can you check on your slide here? Slide here is from subsidiary become associate. And this one is associate to indirect. There is a difference. There is not in your slide. Mm, a little bit difference here. Okay. Yes, we need to use this one. Okay, we need to look at whether that one is from subsidiary to associate, then you can use your notes, your slide from your notes. But this one is from associate become indirect subsidiary, so you're going to refer to these items here, to these methods. Okay, yeah, so we proceed now. Different from your notes, yeah, Puah? Okay, so we proceed. The next one is we're going to look at the value of the company. A little bit different from the one that you have your notes. Okay, P and S. So P and S, okay, we need to find the company value. So the company value is said that the group policy is to measure the NCI at fair value. So to measure the NCI at fair value here, so we're going to look at the amount that we have here. The NCI that we have here is 25%. Yeah? NCI 25% here. So to measure the value of the shares during that date, it's RM1.50. So RM1.50 time with 60. So the fair value of the company here will be 90 million. So 90 million time with 25% to find for the NCI. So the value of the NCI will be 22,500. So 22,500. Parents portion is 70. From the amount that parent COI here is at 70. So the total amount of the company values here will be 92,500. Yeah? So a little bit different. So last time you just time this one 1.5 time with 60, then you're going to have 90 here. But this time, because it said that item number 10 here, you refer to item number 10, it said that the NCI is measured at fair value. So we need to start with the NCI first to find the fair values here. So for the NCI value will be 22,500 plus parents here, parent investment is 70. So we're going to have the company implied value here will be 92,500. So, okay, compare with the net identifiable assets here. Shares capital 60, RE at the acquisitions here is 11.4. So you're going to have 71,400. So the goodwill that you have here is 21,100. So, okay, 21,100 here. So parents portions here 16,450, and then this one is portion for the NCI. Yeah? Okay. So is it okay with the goodwill here? Okay, so that is what you have. Okay, so then we said that the company dispose 20% of the shares, so means that they dispose 15%. So 15% no loss of control here because you have 75. Now you dispose only 15%, you still have a 60%. So you still have a control, even though it dispose of 20% of its holdings. Okay, so now we're going to calculate for the disposals. Since there is no loss of control, we need to calculate a movement in equity. Movement in equity. Then we use a cost method, or we can use a net asset method. So the simple one is a cost method. So the cost method, the sales proceed from the dispose of that 20% or 15% that we have here. Here received here is 15,300. So 15,300. We dispose here 15,300. Cost of investments here. Cost of investments here is 70. Here is your COI. Time with percentage that dispose here from your investment here is 15 divided by 75 here. So we're going to have 14 here. So gain on disposal for the parents here will be 1.3 here. Compare with this figure 1.3 minus the post acquisitions profit. Post acquisitions profit 15%, percentage that we dispose 15%, time with 16,800 here is the, what is your 16,800? 16,800 here is the RE brought forward, isn't it? Okay, RE brought forward. Minus RE at acquisitions. So we're going to have 810 times 15%, this amount times 15%, so we have 810. So you're going to have here a positive movement in equity 490, yeah? Or if you want to calculate using the net asset method. Okay, so you can Nara, later on you can look at the for the recorded class. Yeah? Okay, so going to have here shares capital. So this is a net asset method. You can use this method or can use this method at the end. The movement here will be the same. Yeah? Okay, so you're going to have shares capital 600, returns earnings 16,800. So you're going to have 76,800 times with 15%. So 11,752. So goodwill that you have here 16,450 times with 20%. That's 20% is the one that you have in appearance. So you're going to have 3,294. And then the disposal price is here 15,300. So you're going to have a positive movement. I think this method is much easier, the cost method. So just use a cost method. Yeah? So we're going to look at that one. So you have a positive movement for the disposal of that 15% or 20% of that amount of your disposals. Okay, now you're going to look at here. Going to record for the investments. Investment that you dispose. So dispose here is only 15%. Debit the investment in S. So investment in S here is at cost. Okay, at cost that we have here. Okay, and then gain. Okay, gain on disposals that we have here is 1.3. So under investment income, 1.3. And then NCI here is 15,500. Dispose here is put to the NCI because this one is only a movement in equity. Movement in equity. Okay, and then since you have a positive movement here, you're going to debit the NCI and then credit the returns profit brought forward. Okay. This one is to record for the disposal. So this journal entries here is to record for the disposal of shares. Okay, that 20%. Okay, now we start with the elimination. So eliminations here, the shares capitals at the acquisitions date, you have 75%. At the acquisition date, we have 75%. So time with that, 60 shares capitals. Okay, 45 return profit. Okay, 11.4 time with 75. Okay, the goodwill on consolidations here. Have we calculate the goodwill on consolidations here previously? We have the goodwill. Okay, this is what you have for the goodwill. Okay, so this is the goodwill that you have here. That is my. So this is the goodwill for parents. And then this is goodwill to the NCI. Okay, so goodwill for consolidations you have 16,450. Okay. Credit investment, yeah, credit investment. Okay, and then the additional informations number 2 here we have upstream sales. Upstream sales here is SO to P, yeah? S to P. This one is between S&P and SM. Yeah, so you have additional shares here. Sales 9, yeah, and then cost of sales 9 million. And then from that one you have the ending inventory. In ending inventory, you still have another 3.2. Yeah? So 3.2 time with 25% sales for the URP, debit cost of sale, credit, ending inventory 800. Okay, and then this 200 is from last year. So this is the URP brought forward. Okay, so you're going to have that one. URP brought forward, debit RE, and then credit the cost of sales. Okay, going to look at the dividends here. So the dividend that we have here, proposed dividends you have in S here is 4.2. This is a proposed dividend, debit others income, and then credit debit NCI also proposed dividends here. So now in the year 2020, 2020, parents only have a shares of 60%. So means that the NCI has 40%. Okay. 2020 because you dispose the shares was in 2019. So in the 2020 the shares that you have here is only 60%. Okay, so NCI had 40% from the amount of the dividends. Okay, so this is a proposed dividend photo. Actually, we prepare this one. Okay, proposed dividends, and then you're going to credit dividend receivables and then credit others creditors. Okay, this one is for a dividend. Okay, the next one we're going to record for the current year profit. Okay, current year profit for the NCI here. Okay, 0.4. NCI have 40% now. Okay, this is a current year profit for S533. Okay, 5533 minus 800 is the URP carry forward. Okay, minus plus 200 is URP brought forward. Yeah? So you're going to have 1973. Yeah? Okay. So that is what you have. Okay. Okay, the next one is for the NCI. Okay, for the NCI here, to eliminate for the NCI, we should start at the acquisition state now. So at the acquisition state, during this time, NCI has 25% because parent have 75%. Yeah? So 75%. So NCI have 25% at the acquisition state. Returns earning here is a returns earning brought forward minus 200 here is from the URP. URP brought forward because this one is upstream sales. You're going to affect your profit. Profit. So you need to minus this 200 profit of the subsidiaries. So going to minus 200. So 16,800 is the URP. Returns earning brought forward. So return earning brought forward minus the URP brought forward 200. So time with 25%. We on consolidations, the one that we calculate above, and then credit the NCI here. Okay, any questions that you have for this one? For P to S. Any questions? Is it the same? We, your answer is the same? Is mine or difference? Okay, so we proceed now. Okay, P and A. So P and A now, P has a indirect interest in A. P directly, P have 30%. I can see. Okay, P have 30%. Right, okay, P, and see I have 45%. Okay, this one is S. S has 25%. NCI has altogether you have 55, so NCI have 45 here. Okay, now we're going to determine the company value. Okay, the company value will be based on the value of the NCI. So value of the NCI, we should have this one. Okay, so I'm going to calculate that one, the value of the NCI here. Okay, NCI that you have here is 45. Okay? 55. Where to get that 55 here? Okay, NCI or shares of capitals here. Okay, 80 times 0.5. Okay, 80 is number of share times with 1 ringgit and 50. 1 ringgit and 50 is a value of A at 1st of March. Value of A at 1st of March. So 1 ringgit and 50. So we're going to have this one is equals to 120. So 120 here times with 45%. So with 45%, so you're going to have 54. So this is what you have. Value for NCI 54. Okay, 36 here. Where does 36 come from? Okay, 36 here. Okay, where that figures come from? 36. Any of you have an idea where that 36 come from? Okay, 32 is given. Okay, where is that 36? Where this figure come from? 36. 32 is already given here in additional informations number 1 is given here. 36. Where to get that 36? 36 is from where? Okay. Any idea for that one? Okay, time with 45. That one is for 120. And then this one you're going to have here the fair value. The company fair value here is 30%. Time with 120. Okay, because of the company fair value. So you're going to have 36. So 54 plus 36 plus 32. So you're going to have 122. Okay, so that is what you have. Okay, now going to find for the fair value of net identifiable assets. So net identifiable assets, you have 80 plus 11.2. So 11.2 here is the RE brought forward. RE brought forward 11.2. So RE brought forward, and then 5.5 here. 5.5 here is a profit. Profit. Where do you get this 5.5 here? Okay, if you look at the profit here is 6550. 6550. Okay, the profit that we have here is in the income segment. The profit was 6550. 6550 here, we need to minus the URP of 1000. Okay, URP 1000 here is relate with the item number 3. Item number 3. So now the amount of profit here is only 5.5. That 5.5 here is only for 8 months. 8 months. Why at 8 months here? going to start from July until February. Why July here? Because the July here is the one that you have acquired a new shares. Okay. The one that July. Why that one is a July here? If you look at here, July, what we have here is you dispose. Okay, July, from July until February next year. So you have the year end here is 30th of June. 30th of June. So until February profit here, going to have 8/12. Okay. So altogether you have 94.9. 94.9. So that 94.9, this one is equal to 3.7. 9. So total up, and then 25% for the S, 30% for the P, and then another 45% for the NCI. So the goodwill that you have here is 27.1. So from that 27.1 here, time with 25, so 8.275. This one is time with 30. Okay, time with 30. How to get this one? 36, or you just minus this one, 32 minus this figure, 23, and then this one 36 minus 28, 54 minus 52. So we're going to have that goodwills and locations of goodwills. Okay, instead that NCI 1, 2, okay. NCI 80%, parents goodwill here. So from parents goodwill that you have here is 8 to 5 is it from the S here. So we only need to time with 60%. 60% because parents already disposed 15%. So the amount will be, then you add with this amount. So going to have here is 8275 times 0.6 4965. Okay, stop with this one. Okay, so this is what you have for the goodwills. Okay, so you need to revalue the investment of that 30%. So when you revalue here, the fair value here is 80 times 0.3 times with 1 ringgit and 50. Yeah, so you're going to have, this is what how we calculate this one previously. Okay, so you're going to have 36. The carrying amount here is 31. 31 is at the acquisition when you bought that one on 1st of July. Not 1st of July. You bought that one on 1st of January 2018 at the price of 31. This one is the value on 1st of January 2018. Yeah? So 31 time with plus with the profit. Profit here is 2070 here is 0.3 time with 11.2 minus 8 is this one is for the RE plus 0.3 time with 5.55 time with 8/12 from July until February. Altogether, you're going to have 2070. So you're going to become 33070. And then we're going to have a remeasurement gain here of 2930. Compare with these two figures, we're going to have a remeasurement gain here. Okay, so the remeasurement gain will be 2930. Okay, your journal entries here, debit your investment in A, 5, and then credit returns profit. Okay, credit return profit here is the amount that we have here. This one is for the RE. And then you're going to have your gain on remeasurement 2930. Okay. So you can prepare the journal entry. Okay, debit investment for 990, credit RE for 990, and then debit investment 340, and then remeasurement gain 340. So okay, that is another method to calculate here. Okay, so this is your remeasurement gain. Okay, so we're going to proceed with the next one. Okay. Okay, said that as acquired 20% interest in A on 1st of March So meaning that combinations of income statement, combined of income statement, A as a change status from associate to subsidiary. You change status from associate to subsidiary starting from 1st of March until 30 June. Yeah? Starting from 1st of March from associate become a subsidiary. So you only prepare a consolidated segments of a consolidated financial statement starting from 1st of March until 30th of June. Yeah? So the early income statement 8 months between July until February need to be exclude from the income statements. Okay. The notes is a little bit different here because you are using from associate to subsidiaries. So we need to eliminate that one. Okay, the sales that you need to eliminate here is only for 8 months. Previously, you need to eliminate the previous one. So that it says for 8 months only, starting from July until February. And then others incomes. Okay, others income here is 1.5. 1.5 here is your other income that we have here. In your income segments, you have others income. So others income that we have is 4.5, 2.5 here, 1.5, which is 2.5 minus 1. Yeah, 1 is from the URP. Okay, 1.5 times 8. And then this one is come from the gain on the lens intercompany transactions. So we need to minus others income here is 1.5 only because it's supposed to be 2.5, but we need to minus 1 million from the land inter URP for land. Yeah? So minus 1. Okay, cost of sales, credit cost of sales is 15,600 from your income statement times 8 over 12. Operating expense also the same thing. You're going to have 5.1 times 8 over 12. Tax expense 2250 times 8 over 12 also. And then difference here is you're going to credit the return profit to transfer to RE from income statement's current year profit. Okay, from the current year profit, we're going to transfer to the RE brought forward from the profit of the year. Okay, from a profit, current year profit, transfer to the RE brought forward. So you're going to have here 3.7. Yeah? Okay. So this is the one that you calculated previously, yeah? 3.7. Okay. So balance this one actually, yeah? So a little bit complicated, say. Question 2 is a little bit complicated. So just proceed with the journal entry. Down if you have a question, say. Okay. And then we're going to count for the investments here. Okay, shares capital here you have 45%. So this one is COIS 68. So 45%. And then return profit 45%. So you only have 45%. So you dispose that 20%. So you're going to have 45% only. So 45%. Time with 80. This one is 45% of return earning plus 3.7 here is the RE that you transfer from current year profit to the RE. Current year profit to the RE. The previous journal entry here. So the RE here 11,200 plus 3.7. Yeah. Going to have that one. NCI here, NCI portions here is a direct NCI here become 40% because parent now only have 60%. So 40%. Okay, time with the COI by parents here. Parents in this case here is as investment here is 2. Going to have here 32 time with 40%. So we're going to have 12,800. Could we on consideration we already calculate above. Okay, previously we already calculate for the goodwills here 12.95 portions of the parents in the indirect interest. So and then credit investments. 32 here is from by S and then 36 here is by parents. Okay, altogether you have 68. Okay, and then you're going to eliminate for the intercompany transactions here. Others income, you have 1 million from the URP of the land from here. One that you have here, URP from the land. And then your interest for the NCI. Okay, just want to finish a little bit here. So interest on the NCI here is the shares of profit. Shares of profit that we have here, since parents have now 45%, NCI have 55%. So 55% time with 550 time with 4 over 12. 4 over 12 here is from March to June. Yeah? March to June. Okay, and then you need to plus with 1000. Say minus the current year profit will already minus that amount. Yeah? Okay, so this is what I have 1070. Suppose that this one is we are using 550 time with 4 over 12. Okay, time with 4 over 12. And then we're going to time with 55%. Okay. For 554, try to calculate this one. 5554 time with okay, 1854 time with 0. Okay. Okay, suppose that this is the profit that we have after we minus the URP. Yeah? So we're going to have 1017.5. Yeah? Okay, so you need to minus 1000 because land. So we're going to minus that one. So using that figures only. Okay, and then for shares capitals here, for shares capital, 55% time with 80. Return profit, this is how we're going to calculate for the returns profit. So return profit is 11.2 plus 5.5 here, time with 8 over 12. Yeah? We're going to have 8195. Okay, goodwills here, 27.1 minus portion for parents here. Portion for parents here is 12. 495. So we're going to have 14605 and then credit NCI 66800. Okay. So that is what you have for journal entries here. Okay, I'll show you the income statement. So just copy the answer for this one and then try to redo that once again. Okay. Okay, just like this one, try to redo that one once again. Okay, and then this is the statements of comprehensive income. And then this is the statements of financial positions. Okay, investment. Okay, this is how they calculate the returns profit. But very complicated, isn't it? For questions 2 here. It's a little bit different from the one that you have in notes, because from associate becomes subsidiary. In your notes, it's from subsidiary become associate, will be the other way. Okay, just check the answer for this one. And then try to check if there is a difference from your answer. Okay, you are going to allocate some time for the discussions. We still have one more question, sir. Questions 3. So questions 3 we're going to discuss on this coming Thursday together with your tutorials. Tutorials on chapter 4. Submissions of tutorial chapter 4 by this coming Wednesday. So discussion will be on Thursday so that you have enough time to study for your test 1. Test 1 we cover topic chapter 3 and chapter 4. Okay, just stop sharing this one. Once again, I want to share with you your attendance. A bit rushing to discuss this one. Make sure that if you have a question during the questions 2, okay, I'm going to allocate some time. Sorry, which one that you have? It's a must to prepare. Okay, it's up to you because let's say like the one that we have here last time in question 1. In question 1, it provide you with 2 kinds of answer. Answers D and C and the combination without statement of changes in equity or with a statement of changes in equity. So normally to save time, we just make an adjustment in your statements of financial position without preparing your statement of changes in equity if not required in the questions. If not required, you can prepare or you just skip that one. You just read, make an adjustment, okay, a plus or minus in your return profit and NCI in your statements of financial positions. Okay, the advantage of preparing the statement of the changes in equity here, you can just use the amount that you have in the ending balance in the statements of changes in equity. Just transfer that amount in to your statements of financial position. Just refer back to the question 1. Okay, the first one, if you look at the answer D here, is different from C and D. D is with preparations of statements of changes in equity. If you look at the item financed by, just use the amount of owner equity without providing the RE figures, and also the NCI. So look at the difference between answer D, C and D. Okay, look at the question 1. Okay, question 1, the answer for the SOA, so SA, they provide you with 2 answers. Okay, the D here is with the statement of changes in equity. C and D here is without the statement. Just combine C and D's together, without preparing the statement of changes in equity. It depends, but I prefer the second one without the statement of changes in equity, because if you prepare that one, it takes some time, but it's going to guide you. Okay, or if you already prepare, you just use the figure from the statement of changes in equity, transfer to the segments of financial position, means that you minimize item under finance by. So because you only have owner equity, which is a combination of the RE, shares capitals, and also the NCI. Okay. 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 So marks will be given. Okay, actually, the marks will be given in the segments of financial position, but if you already prepare in the segments of the equity, they're going to transfer that marks to the segment, because some of you like to give only the answer, the figure, the ending figure, without showing the plus minus item, how to derive to that figure, like the one that you have for mid-sem last time. You only provide the ending figure, the end figure, means that without a calculation, you miss a lot of mark for that one. Yeah? So be careful for the next time. Please show all your calculation, even it's not required in the question. Just show all the calculations that you have, not only the end figures. Okay, so for those who have a class, okay, you can leave the meetings now. For those who still have a question, I'll still be around because we have another 1 minute or 2 minutes here. Okay.